The market is shifting and we're seeing more and more and more properties expiring off the market or having to take price reductions. Sellers that are struggling to get an offer often don't want to compromise on their price, and maybe you're feeling the same way. So in this video, we're going to talk about a strategy that can help you get your price and get an offer. But honestly, this strategy might not be for you, but if it is, you're gonna find that this is gonna open up an entire new pool of buyers that you didn't even know existed. Now, the shift is rooted in all of the increasing prices and costs of homeownership and buying property. So we're seeing things like rising insurance, association assessments, and with rising interest rates, we're seeing a lot of buyers who are absolutely terrified to step into the market. But if you're one of the sellers that has a property on the market that can offer them something that helps them overcome those costs, you're gonna find that you have buyers banging down your door to get your property sold. In this video, I'm walking you through 5 reasons why seller financing might just be the solution that you're looking for and what you need to know going into this. So let's dive in. Reason number 1 is that you get to be the bank. And in that sense, you can actually make compound interest. Now, we've seen that, yes, like there is high yield savings accounts, but we've seen the stock market hasn't been performing as well as it has in the past few years. And with interest rates on the rise, you can actually set your own terms when you do seller financing. That means you can charge whatever interest rate that you want. If the buyer is going to take advantage of it, you get to set that rate. You can also have what's called a balloon payment at the end. Being the bank doesn't mean that you have to offer the buyer a 30-year mortgage, right? You can choose the terms here. So you can say, I only want this to be for 3 years or 5 years or even 2 years. And so that's assuming that, when interest rates come down, the buyer is going to be able to refinance at a lower rate. And so you get your cash out. Now, the benefit here is if buyers are not willing to purchase property at the price that you want today, you can actually say, hey, listen, you have to refinance within 2 years. And that has to be done at the price that I'm asking for. And so you'll find that buyers are going to be willing to do that just because it opens up inventory of property that they weren't able to purchase before. Reason number 2 is that you open up a much larger buyer pool. It's no secret that interest rates have basically 2.5 times over the last couple of years. And so what a buyer was able to afford a couple years ago is not the same thing that they can afford now. And so a lot of buyers are like, I'm willing to give you your price, but I need it to be within a monthly payment that I can actually comfortably pay. And so we're expecting over the next, 18 months or so that interest rates are going to come down. And granted, the Fed has kind of gone back and forth on this a little bit because they are waiting to see inflation hit the numbers that they're looking for. And so, we are sort of speculating this, and yet that's kind of the cycle and nature of real estate, right? Rates go up, prices come down. But when rates come down, prices then go back up. And so being able to help a buyer who's willing to give you your price but needs to stay within a specific monthly payment might actually be the best option for you. Reason number 3 is less taxes. This is going to be one that we definitely want to loop in your tax attorney or your CPA to make sure that we're taking full advantage of it. This strategy especially works in cases where you're going to end up having to pay capital gains tax. Now, capital gains is something where when you sell property, and by the way, a lot of people think that just because it's your primary residence, you're not going to have to pay capital gains on it, or you can do a 1031 exchange. You cannot. You absolutely cannot. There are ways around this, and this is one of them, okay? So in the event of capital gains, let's say, for example, I'll use one of the properties we recently sold. We sold the property to the owners for just a little bit over $1 million. A couple years later, we sold it again for them for 1.9, and so they actually had a gain of $900,000. Now, there's a couple of kind of calculations that go into this, like calculating closing costs and any repairs that you've done to the property. So let's say after everything, their actual gain was, let's call it $700,000, right? Now, as a married couple, when you have a large gain, you have an exemption on $500,000 of that, meaning that they would end up having to pay capital gains on the remaining $200,000. If you're an individual and you're not married, then you have a $250,000 exemption. So in this case, If you decided to do seller financing, this is considered to be something called an installment sale. And so in an installment sale, you only actually pay taxes on the money that's recognized in that same year. And so again, make sure you loop in your CPA or your tax attorney to make sure that we're optimizing this in the best way possible for you. Reason number 4 is that you have much less responsibility than if you were to just rent the property out. So think about when you deal with renters, you have to deal with every single clogged toilet, every light bulb, every little thing that you're gonna end up having to run over to the property and deal with. Versus when you're dealing with seller financing, the property actually belongs to the buyer, and the only way that you end up having to get re-involved is if the buyer falls behind on their mortgage and you actually get to own the property again. So with this way, there's actually a lot less risk involved, and you don't have to deal with any of the maintenance or expenses like taxes or association fees or anything like that. And reason number 5, I kind of already alluded to, but reason number 5 is the property acts as collateral. So if, let's say, the buyer falls behind on their mortgage, that means that you actually get to take that property back. So you got to collect mortgage payment for several months going. You didn't have to carry any of the expenses of the property. And then if they end up falling behind, then you can actually foreclose on them just like a regular lender and get that property back and resell it to another buyer. If you think this might be a good option for you, we're going to include a seller financing calculator down below. So make sure you check that out to see if this even makes sense for you. Now, in the next video, I'm going to walk you through 3 different types of seller financing that you might actually want to consider. So please make sure you subscribe so you know exactly when that video comes out. I'll see you in that next video.